So on behalf of BioBreak, I'd like to welcome everyone to our business development and deal making panel. My name is Marty Lehr. I'm CEO of Context Therapeutics. I'm also the director and organizer of Philadelphia BioBreak and a co-director of the BioBreak National Organization with Geoff Meyerson of Locust Walk Partners, who is also on this webinar. I just want to remind everyone that this session today will be recorded for our membership and made available. Because it is a webinar, you will only see the actual panelists on the call through your Zoom portal. But what I suggest is we want this to be an interactive panel. If you have questions, comments, concerns, at the bottom of your screen, there will be a tab that has a Q&A box. Please feel free to submit questions. I will do my best to work through them and ask the panelists. We have also received questions ahead of the panel from some of our members, and we can work through those questions as well. So most importantly, I want to thank all of our members for participating, and as well as our esteemed panelists, all of whom are very good, in some cases lifelong or quasi-lifelong friends of mine at this point. Colleen Cuffaro is a partner at Canaan Partners. Melissa Epperly is the CFO of Zentalis Pharmaceuticals, and Geoff Meyerson is co-founder and managing director of Locust Walk Partners. Unfortunately, Jake Van Naarden, COO of Loxo Oncology, could not join us today. He actually is still without power. So to those of you in our membership who are still working without power, we feel for you and are wishing you the best in this challenging time. So with that, we're going to go one by one, introducing the panelists and having them each tell a little bit about themselves. Melissa, why don't we start off with you?
Sure, happy to. Thank you for having me, Marty, and a pleasure to be here with you all this afternoon. I'm, as Marty said, the CFO of Zentalis. I joined the company last September with the goal of taking us public. We're recently public as of April, and we just closed our follow-on. So someone pointed out to me yesterday we're the perhaps first and only company to raise money twice during this pandemic, for which we're very grateful. By way of background, I started my career in investment banking after studying pre-med at the University of Virginia, and then have since then moved through investment banking, consulting, equity research, done a few different things, moved to the buy side and did debt investing, distressed debt investing, and then the last few companies I've been a part of, very pleased, very different, but all oncology-focused biotechs.
Wonderful. Maybe moving counterclockwise, Geoff, would you like to introduce yourself?
Hi there. Nice to meet everyone. Marty, thanks for getting the BioBreak webinars going. I think this is the first, and definitely appreciate your efforts and everyone else's efforts to have this kick off. You personally have done a heck of a job building Philly BioBreak into the success that it is, so I'm personally grateful to that, and I think all of Philadelphia is as well. So brief background on me. I'm a recovering investment banker, recovering venture capitalist, and was also at a small and big biotech company in business development before starting Locust Walk on September 15th, 2008, back when that was a real crisis. I think we've since met its match. But it's nice to be part of this esteemed group. Briefly, Locust Walk, we help biotech companies with their strategy and then execute transactions on a global scale across strategic deals, financings, regional, global, buy side, sell side. So happy to talk further as appropriate, but I'll pass it back to you, Marty.
No, I appreciate that. And we have absolutely met the economic downturns match this time around. I guess for participants, you can put all the ages of the panelists, and it's rather remarkable that, you know, for all of us, this is our second downturn in our careers that we're already working through. So very much hoping there's not a third and the fourth in the next few decades. Colleen, we'd love to hear from you now.
Sure, thank you. Likewise, I'm really pleased to be here, so thanks for organizing and inviting me. So Canaan Partners is an early stage venture capital firm that's been around since 1987. We're currently investing out of our 11th fund, which is $800 million. And we're one of the few remaining firms that remains diversified and that we have both an active tech and healthcare practice within the same fund. I sit on the healthcare side, where we invest in mostly very early stage biopharmaceutical companies at the seed and Series A stage. My own personal background, I'm a scientist by training. I started my career working as an analytical chemist at a small CMO, where I worked on all small molecule drugs, everything from preclinical feasibility work through commercial drug supply. Did my PhD training at Yale in the Department of Cellular and Molecular Physiology, and then joined the Canaan team on the East Coast in our Westport, Connecticut office just over 6 years ago. So thank you very much, and look forward to the discussion.
Well, since Colleen, you have your volume on, we'll go right back to you. So Canaan is a unique firm in that not only does it do tech and life sciences, but within life sciences, you're both a firm that's active as a participant in financings, as well as a firm that will start companies. Very hard to find substrate, meet with management teams, start companies, invest in new companies during a global pandemic. What's the investment process been like for you at Canaan, and how are you changing your process to adapt to the times?
Yeah, it's a very good question, and I will say that my answer has evolved over the past 5 months since we've been working from home. So I think initially when the stay-at-home orders were first put in place in early March, we, like many other firms, took a moment to review our portfolio very carefully, anticipating that we thought the public and private financing markets would dry up. I think it has proved to be the exact opposite case, and I remain astounded at the exuberance that continues today. We're very fortunate to find ourselves in that situation for early stage biotech financings and public offerings, but nonetheless, back in March, I think we didn't expect it to be what it is today. So we did careful portfolio analyses to examine the cash positions of our companies, and had a lot of discussions about how we would operate in a virtual world. But as we came to realize that the current situation will continue for a while, we just adapted like others, and are continuing to see a lot of new deals, and we're working by Zoom. And aside from the 4 days last week when I was without power, Wi-Fi, or cell signal, it works quite well. So I think there are some challenges, but also some advantages to working in this way. So on the positive side, I find it is much, we can schedule meetings much more quickly without travel on people's calendars. We can have a very rapid turnaround for follow-up meetings with companies where we're in the middle of diligence. On the challenging side, I think this is very much a relationship business, and when we invest in a company, we're really looking at working with the management team over a handful of years. And so it's very important that we build those relationships, and that's a large part of what we get out of the diligence process. And we're trying to figure out how to do that by Zoom, and I think it's working as well as it can. We just spend maybe more hours on Zoom and try to schedule some sessions that are less formal to mimic what you might get out of a lunch or dinner meeting, where you kind of really get a feel for people. So, we have closed on a tech investment where we hadn't met the team in person and did everything by Zoom. We just are about to close on our first healthcare investment, a seed investment, where we have not met the individuals in person. So we're continuing forward because I think there's really no alternative at this point.
That was very, very insightful, and a good transition to something in the pre-panel call that Melissa talked about. So for those of you who are unfamiliar with Zentalis, and Melissa will tell you a lot more, It was the first company to go public during COVID, raised a bunch of money as a newly emerging company, which means you need to hire a lot of people. And so doing that efficiently remotely takes a little bit of skill. And so maybe Melissa, you can talk a little bit about the growth of Zentalis, and then how you've been going about the hiring process.
Yeah, sure, happy to. And I'll pick up on something that Colleen just said about how even their investment process and behavior has evolved as we've gotten deeper into the new reality we're operating within. So we were preparing to go public, and we did in fact go public, but back in March. The world was very different even from where we are now, and finding ourselves in August, where although we were starting to use Zoom, we really weren't using it that much from a video perspective. It was almost always just telephonically. So we've definitely migrated, and if I compare and contrast the process that we used for our IPO versus our follow-on, which we did at the end of July, and in our IPO, there was only one video meeting. And in our follow-on of the 40 or so meetings that you can fit in when you're doing a virtual roadshow, I think almost all but one were by video. And to Marty's point, what's been very interesting, and happily to now that we have secured these use of the proceeds from these two offerings, they're very much to do additional clinical trials. But to do additional clinical trials, you need to hire significantly. So we're hiring. Zentalis is a biotech based both in New York and San Diego, usually, although everyone is mostly working from home, except our lab folks who are rotating thoughtfully and carefully into the lab in San Diego. But for anyone who's interested in helping another biotech grow, we're hiring. And as Marty mentioned, one of the more interesting ways we've tried to do and overcome some of the challenges of not getting to meet your future teammates in person has been first meeting on Zoom and video face-to-face for probably, as Colleen said, a little bit longer than you would in a general interview process. And then especially in San Diego, our teammates out there have found a few kind of generally conveniently located parks, and then gotten to have folks meet them, again, socially distancing, but so that they could actually get the team they were about to commit their career to. So it's really been creativity that's helped enable our and fueled our rapid growth in headcount post the IPO. And it's been an ongoing journey where, it is very fun and very helpful to meet people face to face, but we're learning that Zoom is a decent proxy for that, and a few park interactions as needed.
And has it changed your view? You operate out in New York and San Diego. Has it changed your view on proximity? Do employees need to be physically in those cities, or are you now casting a far wider net?
I think it's probably a bit of both. I think that we are open to, finding and working with talent as and where we are finding them. But at the same time, I truly, and I think our team really does enjoy and benefit from getting people together as and when you can. So we historically always got together as a whole company on every board meeting. I think when we can, we will probably return to that norm. So a locus around the New York area and a locus around the San Diego office is what we're striving towards. But we do have folks in Denver and Chicago and other places that are that support the team very actively and seamlessly.
That's great. And Geoff, so taking the banking view, the lifeblood of a banker typically are conferences and intimate business dinners with prospective clients or CEOs and strategy meetings. And those opportunities now are probably few and far between. So what best practices has your group been adopting to make sure you're both interacting with important clients and then sourcing opportunities for those clients as well as your own firm?
Yeah, so it's a good question. It's a good thing I'm not a banker, so I don't have to worry about that. No, we kind of fancy ourselves as kind of a hybrid banker, consulting firm. And so we do things a little bit differently where relationships matter, but at the same time, we also recognize the new reality. So we've done a few things which I think are interesting. One, we've sent over gift cards for Grubhub and actually enabled clients to buy their own meals for delivery at the same time that we're having ours. And so we actually can sit down and have a lunch or a dinner with a client at the same time, which is a little awkward watching somebody eat on camera, but there's ways of, I guess it's no different when you're in person eating with someone. So that's always interesting. There's another secret which I don't think I want to reveal just yet because our Locust Walk team hasn't experienced it yet, but there's other types of things that you could send to people's homes to have shared experiences around. I've done in other groups, mixology classes where you can send a bunch of different drinks and have someone come on and show how to mix. You can do all kinds of other, health-related things. So there's ways of building camaraderie. There's ways of building relationships, whether it's a client or whether it's internal, that I think is really important for culture. Maybe to piggyback off of what Melissa said about kind of the nexus of New York and San Diego, I still don't think that we're going to have a depolarization of the hubs and kind of the East Coast. I want to be respectful to Philly and the West Coast. I still think that people are going to need to be around those areas. But people have more flexibility on obviously the next year or so where they operate out of. But I do think that it's going to still revert to some sort of a mean relative to people still congregating and aggregating in those hubs. So what that's worth.
Yeah. The only thing I ultimately, worry about is this sort of potential civil war between the scientists and business folks. And the scientists really have been on the front lines throughout, and in some cases, literally the front lines. But, many companies didn't miss a beat. They started operating 24/7 with the labs while the entire, G&A structure worked from home. And so how that evolves over time and there's sort of a rebalancing of that power dynamic. But that's the biotech industry. You're either a scientist or a business person or sort of caught in between. Maybe from there, would love to walk through specific case studies for each of you. So deals that you're either incredibly proud of or are intellectually stimulating or a combination of both. So maybe starting with you, Colleen, you're involved with a number of portfolio companies, Iraqis being one that comes to mind. Maybe you can talk a little bit about what Iraqis does, the growth of the company, and their transformative partnership that they recently completed.
Sure, happy to. Iraqis is a company that is developing small molecule drugs that bind directly to RNA to inhibit translation. And we led the Series A there in early 2017, and I've been on the board since then. The company then closed a Series B led by Venbio and Nextech, and then as Marty just referenced, in April just announced a large collaboration deal with Roche. Which is really a transformative deal with $190 million coming in an upfront payment and potential of billions if all milestones are met. So, I'm on the board there, so I am incredibly proud of the deal, but I cannot take credit for it. I'm proud of the team for executing. I think relevant to what we're talking about today, which is, how to run these processes, when to start strategic discussions, and how to do that in the time of COVID. The two big strategic deals that have been done in our portfolio in this time, Iraqis and then Tizona just did a deal with Gilead. The relationship started long before COVID. So I just want to point out that there were plenty of face-to-face interactions, including those intimate dinner settings and such, before the deal got done. So when you are reading these headlines, and I think this is true also of new financings that are getting done, a lot of the relationships did pre-exist the entirely virtual manner in which we're now working. But so with Iraqis, from the outset, we knew that business development would be a part of the model, and that's driven in a big way because there's such broad target space. So I think, we feel strongly that there are hundreds, if not thousands, of RNA targets that could be drugged. And for, a small company, there's plenty that the company can execute on while also carving out space for a partner as well. And there's a lot to be gained by working with a company like Roche with a very strong R&D organization. So from the outset, we knew it would be an important part of the strategy, but we made the decision, board and management together, to hold off for the first 2 years because we really wanted to have a better understanding of what our platform was really capable of before initiating those conversations. So there was a lot of inbound interest. And I think, the team was very good at restraining themselves and saying, we're going to wait and do this when the time is right. I think where we were when the lockdown initially started was at the very late stages of the deal, but nonetheless, we had a 3-day in-person negotiation planned, which was at the last minute called off and held in a virtual setting. And I guess I would encourage anybody who's interested in this topic to listen to a podcast on BioCentury that Michael Gilman, CEO of Iraqis, did with James Sabry, who heads partnering for Roche, where they talked about this very topic, what it was like to get over the finish line in an entirely virtual format. And I'll just conclude by saying, I wasn't part of those discussions, but what I heard from the team and what's covered in the podcast is that in some ways that 3-day negotiation turned into a virtual format was actually really a positive because it took a setting that would have been very formal, a bunch of people in suits, and you put those people into their homes with families and pets in the background. And it just added a human element to a negotiation conversation, which in the end, I think really brought everyone together. And like when we finance a company, we think of it as a partnership where we're going to be working together for many years. I think the same is true here, and it really brought the Iraqis and Roche teams together, which is a great way to start off a collaboration.
Fascinating. Melissa, I'd love to pivot to you. So my understanding is there are at least 7 IPOs on tap for this week in the biotech sector. The biotech IPO window has been open for a couple of years now, but really during COVID accelerated rather dramatically. And there's always got to be a first company that really provides the kindling to the fire, so to speak. And that was Zentalis in this case. So maybe you can walk us through what the process was like, what your expectations were going in. We know what happened on the back end, a very successful financing, but it'd be great to get a better understanding of the play-to-play and some of the background conversations that were going on.
Yeah, absolutely. It is, with hindsight, I'm very pleased we persevered, but, before we got it done, there were question marks and a lot of bravery that was needed across the board. So if I just cast us back a little bit further in history, I joined the company back in September of 2019 when, of course, we were not anticipating the change in paradigm that we're working in now. So just like another biotech, we worked full throttle to get our bankers, our lawyers, our auditors, and our team internally and externally aligned to prepare to go public with an eye of going public around early April. So we started 2020 with a lot of meetings in testing the waters, which are the early pre-IPO roadshow meetings in both San Francisco at JP Morgan and across the month of February with meeting institutional investors, and we closed our crossover round. So with that backdrop, we were doing, as Colleen mentioned, a lot of face-to-face meetings in January and February. But I remember our last February meeting in downtown Manhattan where we were starting the social distancing. A few meetings had been canceled, and I think we air elbowed to the new potential investor who did end up coming into the IPO. And I think we were safely 15 feet away from each other. And we remained so, but we still had a face-to-face dialogue even at 15 feet. And that was the end of February. So on the timeline where we could submit to the SEC, have the time on file, and then flip public to launch the roadshow, could have been as early as March 26th. And for all of those who remember back to, and I know we all do, late March, the VIX, the volatility index, and that is often the bellwether in the stock market, was over 60. No IPO in history had been done VIX over 30 before, let alone near 60. So volatility was incredibly high. No one was going public at this time in late March because no one had gone public since the pandemic, since the COVID-19 pandemic had been declared a pandemic. So we were, of course, supported happily by our inside investors. We were discussing with our bankers on a daily basis and kind of evaluating the market. And there was extreme volatility, but every day, from March 26th to March 27th wasn't an up or down day. So we were monitoring it. And the other huge question that we were grappling with at the time, in addition to when do we go, which was the earliest we could have gone, was launching March 26th, was what if we don't go? And it was the kind of, if we don't go now or soon, then what? And that's what every company would have to ask themselves, what is the opportunity cost to not going? How would the world change, potentially even for the worse? The markets may not stay open. As Marty, as you even introduced this question, the IPO window has been open. Could it be closed right now and stay closed? We're going into an election. A lot of people traditionally want to get their company into the public markets before the election, COVID aside. So there were a lot of companies on this track, and with the support of a few indications of interest from new potential investors, as well as the support of our insiders, our bankers, and the incredible opportunity cost of, if we didn't go now and we didn't make it out in public before the election, and if the world changed dramatically, what it would mean for our clinical trials not to have funding, and the patients that we wouldn't be able to treat and impact, was too high a risk. So I must confess, I didn't sleep a lot those days, but it was at least a short window. So as you mentioned, someone had to find a new paradigm for how one goes public in a new virtual environment. And working with our bankers and lawyers, we designed a 4-day roadshow. So we launched on Monday, the 29th of March, and it was all day Monday, Tuesday, Wednesday, and then we priced that Thursday. And now that is a playbook that has worked well for many companies. I finally slept well that night, that Thursday.
So a normal road show's 2 weeks, migrating to 4 days. What's the thinking behind that, and why are companies adopting it so readily?
Yeah, it's a great question, because of course the benefit of having a longer time period is that investors, Colleen and others, can do work for more time. They don't have to make such a quick decision. So all the more important that when you are embarking on a shortened deal, that people have had time running up to get to know the company, even in a virtual fashion, because you're really shortening the time that companies have to do diligence. The other main reason, and especially back in March, but even our current world of working, is that you, by extending over a weekend, are exposed to just more risk based on time. So regulation could change, the world could change, the number of cases could change, the fundamental function of markets could shift dramatically based on fact and sentiment and outlook. So eliminating that weekend risk is something that I think is a major factor for any IPO or any offering, that if you can eliminate that, that may be something that is here to stay regardless of when we do resume business travel, because getting a deal done more quickly is definitely eliminating that risk factor.
And with such a short roadshow, was there's ever a conversation of a direct listing that makes you sort of wonder, you had a very strong group of bankers, but do you need that many bankers with such a short time period?
Well, in this case, we actually, we did, and it worked very well, and happily our syndicate worked incredibly well together to canvass a very meaningful number of investors that if we hadn't had that many hands rowing together, we might not have built the syndicate of new investors that we did. But there's definitely companies that are exploring, the SPACs or direct listing strategies that may work for other companies. We just pursued this path, and with hindsight are very glad we did. But, every is navigating new paths in this new world.
Yep. That's great. Geoff, your firm has been remarkably active during COVID, helping companies on the strategic side, both raise capital as well as do M&A and licensing deals. So maybe you could start with one of your more recent deals, which was a very large financing in a company called C4 Therapeutics. So if you spend a minute explaining what C4 does, the background, and how you got involved with the company.
Yeah, sure. So I guess maybe before, since that was a crossover, maybe just to piggyback on what Melissa was saying, one of the ways you could accelerate your IPO, and I'm sure she found this out, is the crossover. If you do your job right and you get in front of the right investors, that plus the testing the waters, the TTW, ahead of the IPO enables that 4-day IPO roadshow. If you hadn't had those conversations, there's little chance someone can make a decision off of that short of a window of a conversation.
Geoff, if I can just jump in there, for people who are unfamiliar with the testing the water meeting, is that you're just calling up venture firms and public investors saying, hey, I'm doing a test the water, let's get together? How does that work?
So maybe I'll let Melissa answer that because she was directly pitching on those.
Sure, I'd be happy to quickly. So TTW is a relatively new word in the scheme of things. It came out under the Jobs Act, and it's a benefit for smaller companies that are going public before they're public to be allowed to test the waters. And so as we in finance like acronyms and in biotech. So testing the water, TTW meetings are SEC approved meetings to discuss a deal before the deal has been happening. So you don't talk about price, you don't talk about valuation, you don't talk about anything about the deal itself or shares or number of shares, but you do talk about the company. So exactly as Geoff said, it is a great and very important part of the investor education process that is pre-roadshow. And it's now under the Jobs Act allowed for companies to pursue these testing the waters, and the main difference between a testing the water meeting and a non-deal roadshow meeting is that bankers are participating. It's facilitated by your investment bankers so that there is that chaperone aspect to the meeting.
Gotcha. Well, I knew as well, but I thought hear from the person who just went through it. So just to get to your specific question, Marty, so C4 is in a really interesting space. It's in protein degradation, which is really a new area of biology where you're using the cell's native machinery to actually clear out and destroy or degrade actual proteins of interest. And so you can use a natural biology to affect a disease across a range of therapeutic areas. So C4 it's certainly not the only company in the space. There was another company, Arvinas, that was already public, well north of $1 billion market cap, a lot of interest. A couple other companies have gone public recently. Some are about to go public. And so we're already in an interesting spot of biology. There were conversations that the company was having with investors pre-COVID, so it wasn't a fully COVID deal, but I will say that we did kick off the process with them in later part of March, if not early April. So it was highly uncertain kind of like Melissa was talking through, we actually closed the financing March 26th. So that sounded impressive, but it was actually done mostly before COVID. It's really the ones that kick off in COVID early days that are a little bit more heroic, if you will. But fundamentally, if you have an interesting story, if you have a reasonable management team, a reasonable valuation, and you have good people around the table, you'll get interest in it, especially in this market. In this case, all those ingredients were certainly in play. I would say as a piece of advice that because it's so easy to get in touch with a lot of these crossover investors, and there's so many more companies out looking for capital, you really need to get above the noise. You really need that crossover ready deck. It has to be laid out nice and simple, with all the right milestones, all the right explanation, not too deep, not too shallow, just right. And I think that getting the story right enables you to go faster, because you almost have to lay it out for the investors to do a lot of their work for them. I don't mean that as a sign of disrespect. Certainly the earlier stage folks like Colleen obviously takes a lot more time from a relationship perspective, but a lot of these crossovers, they tend to be a bit more shorter term focus compared to your average early stage VC. And so while relationships are important, it might not be a 5 to 7 year hold time. It's often a lot shorter than that. So just thinking about how to get their attention, how to get their focus, you can actually get these deals done a lot faster even than before. And we got this done. It was technically closed June 5th. We kicked off early April. So it was about 2 months from start to finish on a very, very rapid financing. We had a fairly broad outreach. We talked to US, European, and Asian investors. That was all enabled by COVID. That could not have happened in that time frame with that diverse of an investor set. So the fact that you're on Zoom calls just like this for 10 hours, 12 hours a day, literally all time zones, it is tiring, but it is extremely efficient. And I don't see how we fully go back to an in-person, although I'm sure there'll be maybe some road shows, including Boston, New York, San Francisco, and everyone else virtual. I'm just speculating here. I've heard a few people say that, especially for later stage deals. But I do feel that the Zoom and the COVID, especially with the demand from investors, has played a really positive role, all else considered. We started out with $150 million financing and was upsized to 150, and we were multiple times oversubscribed. So I joke around and say we bought a Louisville Slugger baseball bat to keep all the investors away. But ultimately, no one was harmed, I can assure you. We had a great group of investors. It's all in the press release: Perceptive, RA Capital, Bain Cap, RTW, Adage, T. Rowe. There's 15 of them. And I think what we've learned is getting the right groups into your crossover enables an IPO. The more investors you have in the crossover, the better the IPO is. The bigger the crossover, the bigger the IPO. That's not an opinion. That's actually based upon data. Happy to share it with anyone who has an interest. But unfortunately, it's all based on momentum. There's wild swings in trading. We were just talking about this from some IPOs that are recently up 150% to now being down. And so we don't know when the punch bowl is going to be taken away from the party. So if, as they say, if they're passing the cookies, you take it, and just keep on pushing. That would be my counsel. So I'll pause there.
And maybe, Colleen, for you being on the venture side and not a crossover investor, I'm always interested to hear the push and pull dynamic between the management team and the investors. Because for many management teams, going public dramatically changes the preference stack in a company. And that can be very attractive to management, but I think recently have a lot of cases where it may have been premature for those companies to go public, but they're taking advantage of the window. So maybe you can tell us a little bit about the dynamic that you have with portfolio companies about how to think about going public and how to strategize around that.
Yeah, so I think these are all case by case, and I think this is why it's so important for us to take the time to do careful diligence and know who we're about to embark on 5 to 7 year relationships with, because as you said, there can be these push and pulls, and I think it's very important for us to be in syndicates with like-minded investors and to be working with management teams where we're aligned in our points of view. And so, I think we try as much as we can to try to solve for that at the outset of our investments and make sure we understand the goals of the management team. But I also think there are dynamics that are beyond anyone's control. And I think, right now, there is this open window that a lot of companies see, and they're just running for it. And I can certainly understand where that comes from. But again, those are decisions that are made by everyone around the table. And, it's just important to try to figure that out as much as you can before you get there.
And maybe just a general question to the panelists, and this falls into the hypothetical category. There's been a lot of commentary. It slowed a little bit during COVID about pharmaceutical price controls. Certainly during COVID, a lot of discussion about Buy American, and we have the pending election. So what are your views on those various topics? Do they impact any of your business decisions or those for portfolio companies or clients?
And I would say these are incredibly complex topics, and we could have well over an hour discussion on them. But what I would say is our investment principles have not changed, and that is, we're looking to invest in new therapies that deliver transformative benefits to patients. And so, we get involved very, very early and are typically not still involved by the time the drug reaches market. And so I think we think of things more in terms of the lens of, if this therapy delivers transformative benefit to patients, value will follow. And we get less into the granular details of how it will be priced at the stage that we're investing.
And maybe to sort of piggyback on that and give Geoff and Melissa an opportunity to speak. So Melissa, one of the interesting things about Zentalis is my understanding is you created a subsidiary or JV in China. And then Geoff, one of the companies that you recently helped finance had a global syndicate. And I think we're all aware of challenges ongoing between China and our own government. So maybe you each can talk about those specific deals and cross-border considerations that you had with them.
Sure. Geoff, I'll speak and then please
Go for it.
Jump in. So thank you, Marty. Yes, we a few months ago announced the formation of a Chinese JV, which Zentalis is the majority owner of. And the reason we formed that entity is so that we could pursue and accelerate global trials. And so one way a company could do that is have their own employees set up in different parts of the world. Currently, all of our trials are run in the US, but we're looking to Europe and Asia, as well as Australia, to expand the scope and speed at which we can enroll. We currently have 4 trials ongoing, but soon we aim to have that be significantly more. And so as we do that, the strategy, which the company has been thinking about for quite a long time, is rather than having employees and the global challenge of coordination, have a subsidiary that may have some tied interest from ownership, but also from leadership and vision, so that we really can work as a global force moving these trials forward. So that was really the strategy behind why we formed our Chinese JV. From a perspective, as you were asking before, we are currently phase 1, phase 2, so a little bit different than what Colleen said, but we're still multiple ways from pricing. But of course, we're starting to think about those factors, and of course, it will impact what we're doing. But I think Colleen said it very eloquently when we think about if there's unmet need that patients can be helped with, then we will figure out a way to get it to those patients.
And Melissa, for you, we received a question from one of the participants about Syphilis considerations for the JV. If you can just spend a minute on Syphilis and whether or not it was relevant for the JV.
Yeah, so I must confess I'm not an expert there, but if you're bringing Chinese investors in with Chinese RMB, so the Chinese currency, then there are Syphilis considerations. We didn't have investors coming in with that. We had Asian based investors through Tyborn and OrbiMed Asia that invested in US dollars, so we didn't have any challenges there.
Yeah.
So I guess, Marty, I'm up. So I'll speak briefly to the pricing, but also the Syphilis and Asian angle. So maybe just to take a slightly different view on pricing, I know the early stage VCs and frankly companies typically, I think rightfully, focus on innovation where it could add value and everything else takes care of itself. I think that the investors that go a little bit later stage tend to focus a little bit more on pricing. So at some point, there's going to be a shift relative to the hope and the promise versus the reality and what it's going to be. I guess what I would say is politically, both parties have been relatively hostile towards biotech pricing. So it used to be a Republican versus a Democratic issue, and now you see Trump with kind of the most favored nation pricing. You see some Democrats talking about, price gouging for remdesivir, which is obviously a very innovative product. So I don't think that the election is having as big of an impact because there isn't as much daylight between the options as there might have been in prior years. At least that's my instinct and my perspective. Relative to China and Syphilis, the deal that we closed in March, the beginning part of COVID, had a majority Asian syndicate. And these guys are really smart, really sophisticated folks. A lot of them have money that's already outside of China, but a lot of them have money that's still inside of China, where Syphilis does play a role in getting capital from China out and into a US-based company. So JVs are a great way of getting some of that R&D to remain in China and perhaps having some of the value shift in other ways. So there's lots of different strategies and approaches you could take for that. Syphilis does matter. If these are companies that are, or investors that are upstanding, it shouldn't be too big of an issue. It certainly wasn't in the deal that we were involved with. But I do feel that the rise of the Asian investor is real, and it's something that all U.S. companies should pay more attention to and should be focus on, at least to some extent, for raising capital.
And a question for all three of you. I actually just received this, and I'm unfamiliar with the topic, but the question pertains to a recent IPO in a company called Therapeutics, wherein the existing investors chose to do a unique IPO path, something called a Series I, which enables the 10 largest existing shareholders to buy the entire allotment for the company. And this effectively makes a very tight, basically non-existent trading pool, so people can't sell shares quickly and drive down the stock post-IPO. Is Series I something that any of you have heard of? I see Geoff smiling, talked about. What gives?
Do you want me to go first? Sure.
Yeah, just so that I can add.
So we actually did a webinar with the CFO of Pharma, but didn't talk about this specifically. Look, it's an interesting idea. It certainly favors insiders. It favors people to want to put more into a crossover if you're going to be receiving your full allocation in the IPO. There's a double-edged sword to everything. Not having a float means the tiniest bit of news could drive a stock through the floor. And that's a consideration for lots of new companies who don't have a lot of trading volume. So trading actually can be a real positive. I'm not going to go toe-to-toe with Peter. Peter Kolchinsky, the founder of RA Capital. He's very passionate about this. I've heard him speak about it. It's not for everyone. It's something that I'm not convinced that the traditional IPO process is going to change dramatically, but I'll defer to Melissa or Colleen if you have other thoughts.
I'll go, and then Colleen, please add the concept that exactly as Geoff said, where you put you have a concentrated book, so you don't spread the IPO allocations very broadly as you're going through the allocation process. Was very much discussed as we were taking our company public in March this year, and And I think that going forward, it will be something that we will likely see syndicates of investors migrating towards. I don't know that they will be quite as tight for exactly what Geoff mentioned, and the strategy that we pursued was not as limited as only to inside investors. Other side of that coin is the investors that have been with you and that came in earlier and in your crossover round and early, like Colleen, that support the company, know the company, and want to continue to support the company. So those will be long-term shareholders. And what we and most companies and everyone going public are looking for are those long-term loyal shareholders that support the vision and the long-term goals of whatever therapeutic or technological pursuits that the company is pursuing. So having a concentrated investor base where there is some liquidity, but that you reward the folks that have been loyal as well as the folks that want to have big positions makes a lot of sense.
I guess the only other thing to think about there, Melissa, is that there are certainly public market investors that won't do crossovers, but who you would probably want to have in a deal. And certainly, in talking to C4, without reviewing anything, there were certain people that said, this type of a crossover is not for me, but, when you're ready to go public, we'll be there for you. So you might actually foreclose on lots of other really good investors with that type of an approach.
Oh, absolutely. And my definition, at least, or my interpretation and understanding of Series I is not only reward those people that came in on the crossover. By all means, we are grateful for every one of our crossover investors, but we did not limit the IPO allocations in any way just to crossovers. So,
No,
but because exactly as you said, not only that, but there may even not be the size that some of the public market investors need from an allocation and market cap requirement to even come in. So as you grow as a company and as both in liquidity as well as float, the level of and size of investor shifts as to who can even participate. Sometimes the deals are not big enough for certain investors, but as you grow and mature as a company, then you will be able to broaden your investor base.
Yeah, I don't have anything to add. I think Melissa and Geoff covered it well, and I don't have any direct experience.
Great. I'm going to give participants 1 more minute to ask questions. Otherwise, we're almost at the top of the hour and we'll wrap up. I'm just double check. I saw all the questions. Okay. First and foremost, really want to thank the panelists for joining today. Colleen, Geoff, Melissa, you were tremendous. For those of you who don't know, in the background is Laura Sullivan and Joe Farrell. Laura in particular, thank you for organizing this webinar and working through all the challenges and rescheduling associated with it. I want to very much thank our sponsors, so Locust Walk Partners and Geoff Meyerson, as well as Witham. Your support has been tremendous, and this is our first webinar, but there will be many more this year, and details to come shortly. A recording of this panel will be sent to all participants, so keep an eye out for that email. For people interested in BioBreak, I suggest you go to our website at biobreak.org. We are migrating to a new software system to manage BioBreak. Because of a variety of IT laws that were recently enacted, we can't transfer over our listserv. So we are asking everyone to register once again. And so please do so. We look forward to seeing everyone on future panels and want to make sure that everyone is safe and well. And for those of you that have kids, that the pending school year is one that is hopefully markedly different than last spring in a positive way. So again, Geoff, thank you so much. You were tremendous, and want to wish everyone a great end to their summer. Thank you.
Thanks, guys. Take care.
Bye-bye now.
Thanks, everyone.